Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I offer in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day. Ira Epstein of Linn & Associates with your metals market update for this Wednesday. This is the 19th of April, 2017, about 1:05 p.m. Central Daylight Time. And as we're in the second part of trading on the day now, it's a red day in many of the, in fact, just about all the metal markets. Dollar has a slight gain today. You can see that you're down in the currency markets as well. And the gold wealth really is going to finish out today and settle around the 1284 level. So let's take a look and understand what's weighing on it. You have energy prices down. You've got a red day going in the bonds and the notes, but nothing major there. Grain settling back a little bit as well. In other words, the question is what's going to make markets improve, and that's been the big question. While the stock markets are up a fraction today, led by the NASDAQ primarily, you're starting to really give ground in the Dow, and the S&P starting to look ugly as we're into the lunch hour in the Midwest. When we look at the weekly chart, the one thing I keep seeing is the market's been unable to get up to the weekly upper Bollinger Bands. The market pattern is one of a higher high than there, a lower low. We've had a crossover that is bullish on the charts when the 18-week moving average got over the 100-week moving average, and the market has been making higher highs off that. So that is definitely in the bull camp. When we look at the daily area chart of just closing prices, you have an upthrust. You're in a corrective mode right now from the 1294 level, and you're down from there in the neighborhood of, what, $12 roughly. Okay, correction going on. And you get to see that here. Now, this correction was set up on this chart back on Monday, just this past Monday. We're only on Wednesday. You ended up with an outside day up. You took out the low of that day. You know what I teach here? I teach that when that occurs, it's called a bull trap. And often, I wish I could use the word always, I can't because it's not real, but often the market then tries to correct down to either one of the key moving averages. It could be the 100-day, the 45, the 18. It gives you a whole series of them, I do, that it can work with. You had an up day yesterday. Here's your down day today. Let's put the swing line on to get an idea of what the chart looks like. With this current action, you still have a bullish formation in the sense of higher lows, higher highs. So that part of the chart is good. I want you to look at the 200-day moving average of closes and the 18. They're starting to converge. I expect that to be in the 1267 level, and ideally, gold drops into that level for support. That would be the ideal situation if you are bullish. Crossover to the upside, there. What would negate the chart is either a new chart pattern developing up here or taking out 1248.20. When I look at the Bollinger Bands, you had been up and over the Bollinger Bands for 4 days, got your throwback on it. Take a look. Let's see yesterday where we were at. 1294.10 closed to 1292.70. Day before, you closed 1291.90, so you had 2 days in a row, 3 days in a row, 4 days in a row. I want you to count how many days we were up and over. And here's your other day. So you got as high as 5 days in a row over the upper Bollinger Band on a closing basis. What are the odds of getting to the others? Believe me, if it's at 1%, it's a lot, and that's what the market's doing. Why? If you go back and count how many days you consecutively close over or under, especially in the gold market, it is extremely rare you're beyond 5. Therefore, this correction in the cards. Now, here's what you have to keep your eye on. What does the embedded possibility of the momentum locking in sideways going to be tomorrow? You have 2 days in a row today where the market's closed over 80. The odds favor it won't do so tomorrow. that the market will try to drop further and take that down. Should it embed, you have a whole different world to deal with, because that tells you that the momentum's locked in bullish, and one would think prices would then come back up. More likely, what I would like to see as a technician is that challenge of these key areas here, and then see what to do with them from there. If you were to break down to them and still have the embedded reading, could be very exciting. In the gold-silver ratio, as I've mentioned, the question is, does the rally here take out these highs in the 71 level or fall short of it and get back down under that 69.5 zone, let's call it? We'll find out, but you're in an upthrust where gold is gaining on silver. In the silver market, I think you can see here that the market is just stuck against its 18-day average of closes. Let's make an assumption that the market takes out, and it finishes like this, and it takes out tomorrow 1814. Let's assume that today's lows aren't violated. The market's 1823. It settled right around here, 1824.5, I believe. And so far, the low of the day is 1816.5. If the market were to take out 1814, the odds favor you're going back to challenge that 1800 area, the lower Bollinger Band. If it doesn't do that, you need to still get a pattern that rebuilds here to start where you can come back up if you're in the bull camp to challenge that upper Bollinger Band. I don't see that pattern just yet. So I think it's going to be an interesting game as momentum here is slipping down still and saying that if you believe momentum leads price, that the market's still going to try to come somewhat lower. Getting a bounce today in the copper, but so what? You're still building in the LME stocks, a big amount of copper. There's a lot of people and a lot of analysts at the right thing that are just saying they don't believe that in the second half of the year, copper's consumption via China will remain where it is because they're expecting that the Chinese economy slows down further. We'll see. The market seems to be building that into the 250 area right now. In the platinum market, you've had a pattern of a lower low, a higher high. You've pulled back into support of the 100-day average in green and the 18-day average of close as the market has already gotten out of an overbought condition. So this break could set up a buying condition in the market if it should hold in this general area and then start with a pattern that gives us higher lows. We've already got the higher high. So that's what you're waiting on. If it just continues to fall, you stay with this pattern of a higher high and a lower low. It doesn't take you anywhere. In the palladium chart, you've got a flip-flop of what we just said. It's very similar to the higher high, higher low, but the flip-flop in the sense that the market is riding itself down. It's not up at the 18-day average. It's at the lower Bollinger Band, and you can see it's going to finish the day out very close to it. It's very oversold. It could extend to the 750, 775 level, which is the 100-day average, looking for further support. There's nothing bullish on this chart. The momentum is down. You are oversold, but that doesn't mean that's bullish, and you're riding the lower Bollinger Band. You're not staying dramatically under it, which forces the market to rally from there. In the dollar index, a pause day. How's that for the term? Again, one of these ugly chart formations of a higher high, a lower low. The problem is, as much as our Treasury Secretary says that President Trump doesn't want to talk down the dollar, there's no truth to that. That's all the man does. You know, you can't speak for the president when he says it himself. The dollar is under pressure everywhere if you look at it. Interest rates aren't going up in America. A lot of cause for concern that our economy is again stalling. Inflation not there. And I'll tell you, when you take a look today at the energy prices getting hit, country after country, if we stay down into these levels and can't pick it up, the inflation scenario is not going to be a very pretty one, and that's going to impact people in many different ways. That comes to play with the Moore Research Center. If you're as I am, I look for vehicles that can give me another trading tool. And they have one that I have used for decades. And what it is they have a research center that looks at if you buy on a given day and get out on a given day, how is it tracked over the years? If you use that just on its own, folks, I don't believe in it because even a trade that's worked 15 out of 15 years eventually fails, okay? You get to some point. Trades get added to and dropped on this all the time. But what I do look for are seasonality trades. Example, we're entering the spring. Should gasoline be going up? We're entering the spring. What happens in the grain markets at this time of the year? As we get into the winter, what happens to distillate use, heating oil use? Well, you would think it all goes in obvious ways. Sometimes yes, sometimes no. But what about the right now, periods